My name is Thomas Massey. I am a CPA. I work with individuals and small businesses across the United States to help them navigate taxes, plan strategically, and save money. Today we're diving into tax brackets for 2025, what they are, how they work, and how you can save money by understanding the system. Let's go ahead and get started. First of all, what are tax brackets? Tax brackets determine how much of your income is being taxed at different rates. Many people think that all of your income is being taxed at solely one rate, when in reality, your income is divided incrementally into portions and taxed at different tax brackets based upon your filing status as well as your income as a whole. For 2025, there are 7 tax brackets. The first one is 10%. The second one is 12%. The third one is 22%. The fourth one is 24%. The fifth one is 32%. The sixth one is 35%. And the last one is 37% for your federal taxes. How are your taxes calculated? Well, first off, you start with your total income. Your total income includes everything that you've earned, from your wages, your self-employment income, any investment income that you may have, and other income that may be such as interest income or income from other sources, business income. All of that is added together to determine what your total income is. But don't worry, you're not taxed on all of that. Then you're able to subtract any deductions that you may have. There are various types of deductions: your standard deduction or itemized deduction. Everyone is given a standard deduction based upon their filing status. For 2025, for the single or married filing separately filing status, you're given a standard deduction of $15,000. For the head of household filing status, you're given a standard deduction of $22,500. And lastly, for the married filing jointly filing status, you're given a standard deduction of $30,000. You are able to use that standard deduction or itemized. Itemized deduction includes things such as charitable contributions, interest paid on your mortgage loans, and lastly, medical expenses. Each one of these itemized deductions has its own stipulations or requirements that it has to adhere to, such as medical expenses have to be above a certain percentage of your AGI floor in order to be able to count towards your return. But in the aggregate, all of these itemized deductions have to be more than your standard deduction in order for it to actually affect your return. So in your tax planning and thinking about your tax return going in years forward, you want to make sure that you're paying enough in charitable contributions, or you have enough medical expenses, or even enough mortgage interest paid to understand that will actually affect your tax return. Remember, you are only able to use itemized deductions if they exceed your standard deduction for your particular filing status. Step 3, you will determine your actual taxable income. Once you subtract your deductions from your total income, you are left with your taxable income. From your taxable income, that's when you are determining what amount of money you are actually paying in taxes. First, you look at your tax brackets. Your taxable income combined with your filing status determines what your actual tax bracket is. Remember, your income is taxed incrementally. This is a progressive system, which means that you're never taxed at one particular rate. However, you're taxed at multiple rates across your entire income. Finally, it's your actual tax calculation. After applying those tax brackets, you may also have tax credits, which directly reduce your tax liability, which is different from the deductions, which reduce your actual income that you're being taxed on, whereas the credits reduce your tax liability dollar for dollar. Then any withholding or any tax payments that were made throughout the year would net against what is left to determine whether or not you will receive a refund or if you owe. I have a few examples of how your tax return or how a tax return is calculated. First, we will look at a person with a single filing status with an income of $120,000. Remember, for this single filing status, you're given a standard deduction of $15,000, which means that their taxable income would be $105,000. The first $11,925 is being taxed at 10%. The next $36,550 is being taxed at 12%. The next $54,875 is being taxed at 22%. And lastly, for this particular filing situation, $1,650 is being taxed at 24%. And then, as you can see, for this particular tax situation, this person will be assessed a tax of $18,047. And please also note that these calculations are provided for informational purposes only. There may be other things that may affect your tax return that may change your tax liability, such as deductions, other income, or even credits that will change your tax situation. So this should not be used to determine what your tax situation is. However, work with the CPA or do a similar estimation for yourself to understand what your potential tax liability actually is. Next, we will look at another single filing status where this person is actually making $200,000. Same thing, single person giving a standard deduction of $15,000, which means their taxable income is $185,000. And then same thing again, the first $11,925 of their income is being taxed at 10%. The next $36,550 is being taxed at 12%. After that, the next $54,875 is being taxed at that 22% tax bracket. And lastly, 24% tax bracket, they're paying taxes on $81,650 worth of their income. And as you can see, the total tax calculated for this particular filing situation is $37,247. Remember, next we will look at a person that is using the head of household filing status, which means they are able to claim a dependent on their tax return. However, they do not have a spouse that is going to be included on their tax return. For this head of household filing status, their income is $300,000. And for the head of household filing status, you're given a standard deduction for 2025 of $22,500, which means their taxable income is $277,500. And for the head of household filing status, first $17,000 of their income is being taxed at 10%. The next $47,850 of their income is being taxed at 12%. The next $38,500 is being taxed at 22%. The next $93,950 is being taxed at 24%. The next $53,200 is being taxed at 32%. And lastly, they will have $27,000 that will be taxed at 35%. And as you add up their total tax, they will be, for this particular tax situation, they will owe tax, or they will be assessed a tax of $64,934. Lastly, for the final example, we will look at a married couple that is filing jointly with an income of $140,000. For the married filing jointly filing status, you're given a standard deduction of $30,000, which brings their taxable income to $110,000. For their filing status and their income, their tax situation, the first $23,850 is being taxed at 10%. The next $73,100 is being taxed at 12%. And lastly, they will have $13,050 that is being taxed at 22%. So when you add up their tax, you will see that the tax that they will be assessed based upon their income is $14,028. And the first thing that you can see is this married filing jointly couple is actually paying less than the single person that is making less. And this is a simple example or a simple demonstration of how taxes are calculated and how the tax brackets actually affect each particular tax situation, and how each situation is a little bit different depending on your filing status, the amount of income that you have, and then also any deductions and credits that you may claim on your particular tax return. Thanks for watching. If you found this video helpful, please like, comment, and subscribe for more CPA tax and accounting advice and tips. Don't forget to sign up for my email list to receive regular updates, news, and reminders. Once again, if you would like personalized assistance, book a call with me today. Let's make tax season stress-free and efficient for you.